Profit Share Live tonight here in December. This is SJREI, and you are welcome to ask me anything real estate, and this is especially where the deals happen. So why should you attend Profit Share Live? Well, one of the main reasons is that we want you to stay informed. We want you to learn how to manage your risk and especially connect with other investors. We're here every Tuesday at 6 p.m. Pacific time. So one of the things that I've learned in my education and hosting meetings for SJREI is that people are not taking action. They're afraid of what's going on in the economy. You know, concern leads to fear, fear turns to panic, and panic turns to paralysis. But there's one thing that counteracts all of that, and that's the facts. And that's what we're here for tonight, is that facts defeat fear. You know, many investors know what's happening, like they sense it. Good investors really understand what's happening, but great investors act on what is happening. And that's my goal for you, is that this doesn't just turn into edutainment, but that you take this information and you're able to use it to benefit your family, increase your business, and just get out there and invest for your future. So who am I? My name is Lori Graymont, if you're not familiar. I am a real estate expert. I've been in the industry for over 30 years. I've transacted over $150 million worth of real estate and raised over $50 million of private equity. I have started a TV show called Funding Face Off with many of my friends and colleagues. We'll talk a little bit more about that. And I've done just about every kind of real estate deal, but my specialty is deal making. I love getting deals done that other people can't get done by thinking creatively, thinking outside the box. Like many people, I was in the industry in 2008 and experienced that economic change. And so I know the fear that people are in right now, but I also know what we're up against and have been able to rebuild since then. So that's all knowledge that I bring and I want to share with you. So tonight we're going to go through kind of like what's going on the macroeconomic side for real estate, what's happening micro in Santa Clara County, and then kind of a call to action, like how can you put this information to use? So if we look on the national side, you're going to see that home sales, new home sales increased 5% in 2023. We saw mortgage rates get over 8%. That was scary. Right now, the current jumbo rate is about 7.23. November, existing home sales were 4.1% less than October. Again, people are not selling because they can't really get into homes at those interest rates. And in 2023, surprisingly, existing home sales were 15% more than 2022. The South and the West of the US were showing the highest month losses in the number of sales. So sales numbers are down, but not necessarily prices. So compared to 4.3 million existing homes that were sold, NAR is projecting 4.7 million existing homes in 2024. So we will see more activity, more transactions happening. The existing home sales are expected to increase 13.5% if mortgage rates go down. And new home sales are expected to increase by 19%. So a lot more transactions. But we have inflation. It's kind of been run away. And it's the wild card. Also, there's some things to point out. While national inflation seems to be decreasing, the shelter inflation is increasing. So inflation decreased to 3.1% as of November. But there's projected an oversupply of apartments likely to hit in March. This could soften the rents, which could then soften the shelter inflation that right now is increasing. In 2023, residential appreciation increased as much as 5%, despite earlier predictions that it was going to go negative or that it was going to be zero. There is pent-up demand based on jobs and lack of inventory in these following cities. We have Austin and Dallas, both in Texas, Dayton, Ohio, Portland, Maine, and Washington, D.C. Now, if we go from the macro down to the micro, let's talk a little bit about Santa Clara in the Bay Area. We're talking Santa Clara County. So here you're going to see a graph. In this graph, it's showing you what the price per square foot by month is. So it's showing the average square foot price and the median square foot price. You can see here, since 2008, it was, the lowest. It has slowly been inclining. Now you will see a peak in 2022, then we see a drop, and now it's just kind of bobbling. So it's almost flat. It's like seasonally, we know prices go up seasonally and then come down, but seasonally adjusted is pretty flat. Here you can see the number of sales. So if we look at the size of the sale, so let's say a 1 million to 2 million price range, you can see in 2021, there was a spike as far as the number of sales. And that's as we were coming off COVID. And then in 2022, the sales dropped to, over 6,000 sales. And now in 2023, we're about 4,700 sales. Now, this is because there's very little inventory. So if we look at asking price versus sale price, we're going to see starting in 2018 that it was 8% over for the year. 2019 was asking price. 2020 was 4%. 2021 was 9%. And then this one was a little bit odd here. So you'll see in January through May of 2022, it was 16% over ask. Now you might go, why did we cut off at May? Well, from May until December, it was 4% under ask. And what that was is that's kind of when the rate hikes really hit the market and everything pulled back. So here in 2023, we're seeing about almost 5% over ask, which is good. So now if we take a look at the Santa Clara County median home prices, you'll see the peak in 2022. So we have come off the peak of 2022, but if you remember, 2022 was like ramping up. It was coming off from 21, which was COVID. And then we hit those rates and we came back. So we have fallen off on our median home price from the high of 2022. If we take a look at the annual days on market, we're going to see 2019 is 32, 2020 was 25, 2021 was 18, again, ramping up. And then again, if we split our 2022, you're going to see 10 days or less on the market. Things were getting hot. And then the brakes hit. We were 36 days on the market. And because of that, prices were pushed down a little bit in 2023, but the days on market has kind of normalized again around 25 days on market. So here is a graph that shows it kind of by month. And again, seasonally, you have to understand that the December, January, February is going to be a little bit longer days on market. And then you get into the May, June, July, it drops and typically it ramps back up. But we're holding kind of steady around that 20-25 days. Now, if we take a moment and we look at our listed price versus our sold price, you're going to see some numbers here that are interesting. So if we go back here to November of 2022, so this is after the rate hikes, you can see that there is a lot of properties being listed and very few are selling. And then December, same thing, again, seasonal, but also rate affected. In January especially, then we start to get into the spring and you start to see the solds pick up a little bit. Even in May of 2023, you see that there's more solds than were listed, which is great because then that's going back and grabbing inventory that was on the market a little bit longer. And now we're back down to being seasonally adjusted. But you'll see that, November, December, things are starting to even out as far as what's being listed and what's being sold. And I'm going to show you here on this next graph. There's not a lot of properties being listed. So if you look at the number listed, we have like 1,100, almost 1,200, 1,256, 1,268, and now we're down to 1,063. So tight inventory. So what's going to happen? I mean, we see the year, it finished out well. It finished out well for us. We didn't see any huge price declines. We might have seen, a little bit off from the high of 2022, but really it didn't finish as poorly as many of the predictions were. So let's hope that these predictions are better than last year, because last year's predictions, we got better. So using the predictions that are coming from Carr, the chief economist, Levine, he's saying that he predicts inflation will come down to about 2.6% and that the monetary policy will loosen up. And as that monetary policy loosens up, he expects to see the interest rates come down to about 6%. And then that will cause sales volume to go up. People will kind of feel like, okay, now we can actually afford a house and we can move. And so you'll start to see existing homes come on the market. New homes will continue to come on the market, and that will cause more volume. Now, he's also predicting that medium home prices will continue to trend up, maybe as much as 6%. So what is going to happen in the market? Is it going to go up? Is it going to go down? Is it going to go sideways? One of the hardest things as an investor is being able to predict that. If you've got a trend that you can follow, if it's a market that's going up, you know how to invest. If it's a market going down, you know how to invest. But if it's a market that's just kind of bobbling and staying sideways, that is one of the hardest markets to invest in. So what do you do as an investor? How do you deploy your money? Because if you put your money in the bank and you're all happy about earning 4%, the sad news is that you're going broke slowly, because between inflation and your taxes on that, you're losing money. So you really need to be investing at rates that are, higher than 10% in order to cover your cost of the money being deployed and inflation. And so there's a couple things that I would recommend, and that is considering diversification and considering projects that have value add. So if the market is going sideways, what do we invest in? I'm going to share with you a little video. This is the show that I started. I referenced it earlier. It's called The Funding Face-Off. And I'm going to show this and then I'll explain a little bit more about it.
Funding Face-Off, a brand new real estate investing reality show that changes lives by providing the vital collaboration, knowledge, and resources needed to get deals done. Real estate entrepreneurs from across the country are given the chance to pitch their deals to a panel of experts.
Congratulations, done deal.
That's one hell of a deal. They don't make that anymore.
Funding Face-Off is a way to reach more people looking for financial independence through real estate and entrepreneurship.
Sometimes you have to just get wild and crazy with the offer to the people that you're trying to get the money from.
That's not what I said. Strictly on that part alone, the deal's dead.
The panel of dealmakers select one of 3 presenters' offers and bring the money and expertise to create a profitable investment.
I'm a young gunner. This is not going to be the first one I bring you.
That says a lot to me.
They're in over their heads.
I'm out, and you're gonna live in hell. Trust me, it sounds daunting.
You're trying to scare him.
Nope, I want him to win.
If you take our funding, you're partnering with us, you'll get our experience.
One deal can change your life. and your family's financial trajectory for generations to come.
This is for real estate investors helping each other, helping them succeed by potentially funding their deals.
Done deal.
Find out more by going to fundingfaceoff.com or find us on social media. Thank you for joining our impact investing movement.
Okay, so Funding Face Off is a TV show that I created. Yes, that is Kevin Harrington. There, along with many of my other colleagues, we've got Ryan Roddy Garcilaso, Mike Hambright, Cowboy Joe, John Nolan, and Travis Johnson. And all of these investors have been in the market investing for at least 10 years or more and have successfully managed projects, investments, rehabs, and the such. And what we're doing with the show is we're helping investors who have deals, like they know they have a deal, but they maybe need help restructuring it due to the economy, or they need help with the funding. And we're coming in alongside them, funding their deal and participating in it, creating long-term relationships. The idea behind it is a little bit like Shark Tank, except we use 3 investors. The 3 investors pitch their deals. We eliminate one, so it gets down to 2 investors. The 2 investors face off from each other. So one might offer us a 10% return, the other might offer us a 15% return, and they kind of go back and forth until we say done deal. And then we take the deal and we underwrite it. Now, each one of us as the deal makers has put money into a fund. It's called the Funding Face Off Fund. And this allows us to fund the deals for the individuals on the show. So even though each show only has one winner, there's actually a lot more winners, and it's all of us that are in the fund. So what I wanted to do is I wanted to share with you a little bit about the fund, because we are opening it to more than just us as the panelists. And so if you'll give me the honor here, I'll share just a little bit about what we're doing and an opportunity to have a call with me to see if you qualify to invest with us. So when we look at our deals on the show, and I'll tell you a little bit, the show is going to be coming out Q1. It's not out there yet. It's going to be coming Q1. But I have to tell you, just even recording the show, we're getting deals submitted to us that we're trying to underwrite and trying to fund. And that's why we're opening this up, because we have more deals than we can fund right now, which is great, especially in this economy, because we know how to structure the deals for our safety. So now each deal that we look at has to have at least a 30% return on cost. And that's a key element. So it basically says the deals are value add. Each deal that we invest in needs to pay the fund at least an 8% preferred return and include a profit share component that has a greater than an 18% ROI. We call it forced appreciation. This is value add. And so we're not dependent on the market. You know, a really big deal, I'm sure you've probably heard me talk about it, but just an example about forced appreciation. We were able to assemble 3 parcels, it's actually 7 parcels from 3 owners, and create a 1-acre parcel that we got entitled for assisted living. And we're up about so we added about $10 million worth of value just by assembling them and taking them through entitlement. But we structured the deal in a way that we're not having to carry the ownership of the land. We control the land without owning it, which allows us to keep our costs low and our risk low. So that's an example of forced appreciation and an example of risk mitigation. Every deal that we go into needs to be 18 months or less. We've all seen how quickly things can change, and so we feel that that's a safe window. And no one deal can be any more than 25% of the fund size. So we're looking to raise $5 million in this first round. So we would not be able to take $2.5 million and put it in one deal. We would be limited to that 25%, which is 1.25 in any one deal. This is another way that we are mitigating the risk, because we're spreading it across multiple assets. diversified portfolio, if you will. So the deals will be in the US, and here's some of the things that we look at when it comes to underwriting. Now, every deal is a little different. Not everything gets underwritten on all of these categories, but obviously we want to be paying attention to things like the location, the land value, zoning and permitting, any regulations, what's the market demand, and the financial feasibility. So those are key pieces. Then we look into a little bit further the design and the amenities. Is there an environmental impact that could have risks down the road? What is the long-term value creation? And are there any legal or regulatory risks? Are there unintended consequences? And then, of course, we want to know, what's the exit? What's the backup exit? What is the return on the investment? And more importantly, what is the return of our investment? For example, on the show, we had some people come and present to us about investing with them, but they didn't really think about how they were going to cash us out because they were adding value to properties that they were going to rent and hold. And, we really wanted our return back. And so we had to discuss to them or with them about doing a refinance, and would they be able to refinance to get our return back out? Again, timeline, market risk, development risk, and general partner risks. Is the person that we're looking to invest with a good general partner? If not, are they willing to contribute the deal into an entity that we control called an SPE, special purpose vehicle? And then we would invest in that and manage that. So here's kind of the outline for Funding Face Off. We are a diversified fund. We are investing in commercial, residential, and we're investing nationwide. So just to give you an example of some of the types of deals that we're looking at, we have a self-storage partner that is building some self-storage. There's called storage caves. And these are like larger self-storage, but they're for luxury vehicles, RVs, boats, that kind of thing. And in that particular deal, 10% pref and 50% of the profit on that. We have another senior entitlement that, my company is working on. In that one, there's an 8% pref and 60% of the profit coming to the fund. And then we have, residential lot split where it's recorded as a note at 15% and a small profit split, but still it gets the returns up there. So these are just some samples of the projects that we're looking to invest in. The way it works is you would come in, the minimum is 100,000. And the share price is $1,000 per share. So at 100,000, you would get 100 shares. But for a limited time, up until we have raised 500,000, we're offering the shares at $500 each. So this means that for 100,000, you end up with 200 shares. And I'm just going to show you kind of how the fund works. So if we raise the 5 million, and let's say that 5 million represents 6,000 shares, and let's say that we get a 25% return on that 5 million, which should be pretty easy in some of these development deals. The fund would earn 1.2 million or 1.25. Okay. 70% of that goes to you as the investor. So that would be 875,000. The profit per share is 145.83. So if you come in as a regular investor, you have 100 shares, that gives you $14,583 of profit for the year. So that's about a 14.5% return, which is excellent for a passive investment that is risk adverse the way ours is. It's excellent. But if you come in as a founder, meaning you get in early here before we raise our 500,000, you get 200 shares. And so that doubles. So in year one, you could potentially, this is not a promise, a guarantee. I'm just showing you this as an example. Please refer to the PPM. I'm not making any guarantees of earnings, but you could potentially earn as much as 29,000. using this example. So that's just an example there. But where it gets fun is in year 2, when we bring in more investors. So here, let's say we just kind of double everything, right? So now instead of 5 million, we're 10 million. And this time the 10 million is represented by 10,360 shares. We get the same return, the same profit. So here, you know, this is the profit that gets shared, comes out to 168 per share. Because we didn't necessarily double the number of shares because people are buying in at a higher share price. Every year, the share price goes up. So getting in early, you get the benefit of that. So if we jump down here as a regular investor for 100 shares, you would see 16,891.89. So that's almost a 17% return on your money compared to the first year. And this again is because more people are coming in, the share price is going up, and you got in early. But if you get in early, get in as one of the founders, you'll see here that almost doubles to 33,783.78. Again, educational purposes only. We have a PPM. I'm just sharing these as examples of how the fund works. So some of the overview items for the fund is it's 5 years. So we'll do it for 5 years and then we'll wind it down. And the reason we did 5 years is that as we get into these investments, you know, anywhere from 12 to 18 months, we need the time to grow, right? So grow and keep reinvesting. So there's a 2-year lockup, that's SEC rules. And every year we pay out the profit annually. The price per share goes up every year. So if you get in lower, you have more shares, you share in more profit because you took the risk in the beginning versus somebody who gets in while we're already working on deals that, you know, if somebody comes in year 3, their share price is going to be more, which means they get less shares, you know, because their risk is less, right? So it's risk adjusted pricing. And what we're doing is we're sharing 70% of both the cash flow and the exit. So if we sell something and we get a profit share, or it's a project that we're working on our own, both sides of it, not just the cash flow from the rents, but the exit also is shared at 70%. And for the first 90 days, we can accept both unaccredited and accredited investors. So the founder shares are only good up to the first 500,000, and then the share price goes to the $1,000 per share. So my suggestion is if you have any interest in this, you want to deploy some capital, you're not sure where to go in the market, take a look at this because we're going across the nation. We're not just California. We're not just one state. We're going across many states. We're not just residential. We're not just commercial. We're multi-dimensional on this. And so if you have interest, book a call. Let's see if you qualify. And if you come in early enough, you might even qualify for the founder shares. There's limited availability. Again, once we get to that first 500,000, then we're not accepting any more founder shares, and we're offering the shares at $1,000. But again, every year after that, the shares adjust based on the profits, and so the $1,000 will be, you know, the lowest price, and then as the profits come in, the share price will go up. So one more disclaimer, remember all of this will be disclosed in the PPM, and I'm just sharing this as an opportunity to have a conversation. Thank you. All right, how to book a call with me. Go ahead out to go.oneshub.com/strategy call with Lori. So we'll see you January 9th. This is the last one for the year 2023. We'll see you in 2024. Safe holiday, happy new year, and see you next year. Bye-bye now.